we will now discuss the format of the income statement as well as a very important line item called income from continuing operations. Let's now discuss the income statement and its primary classifications. Remember from our prior week discussion that it reports how much income a company makes over a period of time. Here are some of the key components. First of all, income from continuing operations, which consists of our revenue and expenses directly related to our company's primary activities. There are several steps as discussed previously. That's why we call this a multi-step income statement. We first of all have net sales minus our COGS, or cost of goods sold, to get gross profit or gross margin. Then if we take our gross margin less our operating expenses, which consist of research and development and selling general administrative expenses, that gives us operating income. Lastly, if we add net other income and expense, such as interest income and interest expense, to get to our income from continuing operations. Next, we talk about discontinued operations. Our goal here is to report all the income effects of a discontinued operation completely separately, in fact, net of all tax benefits and expenses. Our separate reporting below the income from continuing operations allows the reader, our investors and creditors we spoke about previously, to make better decisions and also to forecast their future recurring cash flows. And last, we talk about restructuring costs, which are the costs associated with the shutdown or the relocation of some of our facilities or the downsizing of our operations, which we'll discuss later in this module. As previously discussed, it's very important to highlight these unusual or infrequent items in their separate line item on the income statement. First of all, restructuring costs, we've discussed that previously. And second, asset impairments, which is where any long-lived asset should be reduced if there's a significant impairment in its value. So why do we do this? I mean, really, what's the point of this? Well, the point is that by separating these types of unusual items, we can help our readers of the financial statements make better decisions. And also, they do a better job of forecasting the future cash flows of the company. Now, here's some jargon alert concerning earnings quality. We have transitory earnings, which result from transactions that are not likely to occur again, such as restructuring or discontinued operations. Then we have permanent earnings, which is more what we're concerned about. That's a result from usual or recurring transactions. So let's review a sample income statement reflected in this slide. In the middle of the slide, you'll notice we have operating income. That's basically $167 million this year versus $265 million the year before. It decreased by almost $100 million. So the key question is why? Well, 2 lines above that, you'll notice a line called restructuring cost, which is a value of $125 million in the current year. This is that separate line item we discussed a few moments ago. Keep in mind restructuring cost, as we discussed, this involves the cost associated with the shutdown or relocation of facilities or downsizing of our operations. So you want to know how common are these costs? Well, pretty common. 40% of all the companies have these types of costs per a recent AICPA survey. Per GAAP, or Generally Accepted Accounting Principles, we have to recognize this in the period the exit or disposal cost obligation actually incurred. So for example, way back in 1991, Hershey Entertainment Resorts went through a severe downsizing situation where we got out of some operations. We basically had a very significant severance cost related to the downsizing of operations and putting some people out of work. We basically had to recognize that multi-million-dollar cost in 1991 when we made that decision. So now we move on to asset impairment. It's basically when any long-lived asset should be reduced if there's been a significant impairment of value. So impairment affects both tangible, things we can touch, and intangible assets. So tangible assets are buildings and equipment, or more commonly known as PP&E, property, plant, and equipment. The intangible assets are things like goodwill. While we're going to discuss this later in the course, please note that this is the only asset on your balance sheet that occurs only when you purchase another company. This is a very interesting but challenging topic. Stay tuned for a much more detailed review of impairment and its related annual testing later in this course.